Welcome back to the Desk Talk Podcast with your hosts, Trent Werner and Alex.SMagala, bringing you weekly episodes talking business, personal development, and all things real estate. Let's do it!
All right, welcome back to the Desk Talk Podcast. You know, Trent and I sitting here decided today that we just wanted to sit down and talk about the power of leveraging a mortgage, kind of using it to your advantage, and ways to not look at it so much as, oh my gosh, it's this payment that I have to make every single month. And that's basically, literally, we're going to kill it and just murder this episode. Questions for me, because I know you probably have some right off the bat.
We're going to punch this episode in the jejunum.
What's a jejunum?
I don't know. That's from
Hot Rod.
No, Tropic Thunder.
Oh.
Or no, Flint Tropics.
Mm.
What is that movie?
That's right.
Will Ferrell.
Yeah, he's the basketball dude.
Jackie Moon.
Tropic Thunder?
No.
That's not it. No, I really don't know.
Whatever that movie is, that's jejunum. You know, he throws up, whatever. I want to talk about leveraging a loan to grow your wealth. I think a lot of people, like you said, see a mortgage as similar to a car payment. They're taking a loan.
Or rent.
I'm talking about loans. So they're basically financing a object. And a lot of people, when they get out of school, they get their first job, what do they do first? They buy a car. So that's what they view getting a loan as. Mm-hmm. And so when they go to buy a house, maybe they're approved for $500. They're like, hey, I want to keep it at $200 because I'm going to have this big loan in my name. But a car loan is on a depreciating asset, so it's not going to go up in value. A home loan is on an appreciating asset, and it's going theoretically.
Historically, it goes up.
Yeah, it's going to increase in value over time. And I think a lot of people get caught up in viewing loans like a car loan or a credit card payment or whatever it is, and they don't necessarily understand the idea or concept of leverage. And for someone who doesn't know the difference, what would you say on why someone should use leverage to invest in real estate or invest in their primary residence or own where they live?
Yeah. I guess this is going to kind of boil down into kind of two different funnels when you're talking mortgages with people, because you're going to get the client or you're going to get the person that you're working with who is just so set in their ways that is like, I'm just getting this loan and I'm paying it off as fast as I can, and there's nothing you're going to tell me otherwise. And it's like, great, let's deal with that on this side, because there's not much convincing you can do to try and get people who are so stuck in their ways there. But the other side of that funnel is the people who are not really sure about it. They know that you can get a mortgage and pay it down, and that's how you build some net worth, and that's how you get rich these days.
They think that you just built equity.
But there's a lot more that kind of goes into it. So when I'm talking to someone and I can tell that they have somewhat of an interest to use real estate as a form of building wealth and building generational wealth, because I think that's so important behind real estate, is it builds big generational wealth. But talking to these people, you're either going to have to boil down to convincing someone to do it, mm-hmm. or someone's going to be passionate and understand that, hey, there's the BRRRR strategy. For example, you could take Cooper Bruner, shout out to Cooper.
My guy.
He's super passionate about it, and he knows, I want to get into real estate investing, and I want to do this, and this, and so he's doing a ton of research about it on that end. He's not someone that I'm going to have to sit there and convince to look at a mortgage in a different way.
Right.
On this side of the spectrum, where it's like someone's, they're not they haven't hopped that fence, which we've talked about a ton of times, is like getting over that fence. You're on one side of it, and you're just watching people play. It's like, get over and start playing the game. Those are the people that, when you're trying to convince someone and spit facts to them and let them know how much a mortgage can be utilized in different ways, those are the ones where you're really changing a mindset and building a passion through getting wealth through real estate. And those people, I want to say they're easy to convince, but really no one's easy to convince, because you have to provide enough value that they kind of bite into it. And so when I'm sitting down talking with someone mortgage related, and we're getting into the weeds of a mortgage, and I'm asking them, how do you view a mortgage? What are the ways that you want to utilize this mortgage? And they're just like, well, I view it as something I'm going to pay down, and eventually I won't have to pay on this anymore. That's the first stem where I'm like, okay, here's a trigger in my brain. Like, I can really help this person out.
Because they're saying that they have to pay on it.
Yeah.
Not that they get to pay on it. That's
They
boom.
have to pay down this thing. And so it's like, oh, well, why is your mindset that way? Why do you think you have to pay this loan down? Why do you think you have to do this, this, and this? And 90% of people's answers are going to be like, well, you know,
That's
what Dave Ramsey says online, or that's what Google says. That's what this says. And it's just like, I get it, but let's shift the focus to the power of a mortgage.
So you're basically telling people the difference between bad debt and good debt and why you should use good debt to your advantage.
Yeah, and on top of it, I'm providing enough value to where they see me as their official debt manager. And I put debt in quotes because I don't look at it as a debt. And that's like when I'm talking to financial advisors, you know, it's the idea you manage all their assets and you do your job there. Let me do my job on managing their largest purchase or their largest debt. Mm-hmm. Because when someone you have on your side that manages it and is actively looking for ways that you can use this mortgage to kind of jumpstart into another venture, or, I mean, cash out refinances, they're prime right now because people are realizing investing in real estate is more important than investing in their stocks right now or their portfolios right now. And so people are pulling out cash that they've built up in their homes that they thought they were going to pay off to then go and dump onto another home.
Well, right now, with where inflation's at, owning hard assets is definitely better than having cash in a bank account.
Oh, God. Yes.
Yes. That's a different topic. Okay, now, because I've had clients that are like this, it's not a bad thing. When someone comes to you and says, "Oh, I want the lowest rate," and I'll talk to a bunch of people. I just want the lowest rate. I just want the lowest rate. This person is going to leverage a loan to buy a property regardless, but they're so wrapped up in the lowest rate,
the best price.
Yeah, and I know we've kind of touched on it, but I want to understand what you would say to someone that says, "Hey, I am fully into buying a property, buying a real asset, real property in the state of Oregon or Nevada or Washington, wherever you're licensed, and I want the lowest rate because I think that's going to be the best way to leverage myself." What would you say to someone like that?
Yeah, I mean, I get this a ton. They're rate shoppers. That's, you know, the term that they're referred to in our industry. And I don't remember the guy who said it, but there's like the 3 ideas of why to never work with a rate shopper. And it's because, you know, they're never going to feel like you gave them the best deal. So they're never going to refer you to people. I don't remember exactly down the line, but pretty much rate shoppers, they always have had like a negative connotation in the mortgage world since I've started. People have told me like, "Oh, don't work with rate shoppers, don't do this." But I honestly love them. It's a competition. I love to get competitive in things. And so when I'm sitting there and someone first comes to me and says, "I want the best rate," I'm just like, "Well, what rate do you want? Do you have a number in mind? Like, what rate do you want?" And then when they don't know how to answer that question, I simply ask them the next step of, why do you want the best rate? What does the best rate mean to you? What is the best rate going to get you? And when they don't know how to answer that question, it's literally from there, now you've got their attention to be like, why am I even thinking about rate? And that's when you start to give your little sales spiel of, don't think 100% on rate. Let's look at monthly payment. Let's look at how to utilize this because it's inevitable you're going to refinance. Why get the best rate when in 2, 3, 4 years you are going to refinance? It's inevitable. You are not purchasing a home and not going to not refinance that within your first 5 years. I'd put my money on it. You're going to refinance it because there's something that's going to come up. People get bad debt all the time. They're forced to refinance. They went out and fought for that 2.5 interest rate. Now they're refinancing a year later and, oh, now you're at 4.5. Sweet. So what did fighting for that 2.5 interest rate get you?
And I think that is so big because, and I know this from experience, people are not going to have the same loan for 30 years. It's just the way it works because once you start seeing the equity build, down the road, you get excited. You want to take some of that cash out. You do a cash out refi, and boom, you refied.
I think
you have a different loan.
Yeah, I mean,
and hold on, and the idea of someone being like, oh, I want the best rate now, and I've tried to coach people up on this too, even though I'm not on that side of the game, is the average person refis within the first 7 years or 5 years or whatever it is.
It's before 5.
Yeah, and it's like, it's more important to get in the game than wait to get in the game over a rate. And I think what like you're touching on is you can get in the game with a 8% rate, a 10% rate. But once you've, done a rehab project, if you're using hard money to get a 10% rate, you can refi right out of that, and you've already refied.
You found a way to get into the deal, and you've paid the cost that you have to do to there, and now you're forced to refinance.
Mm-hmm.
It's like you found a way into it, and it's inevitable that you have to refinance. You're not going to sit in that loan the whole time.
Yeah,
but it's the same idea. Right now, it's a great time to buy. And people are like, "Oh, why? Home prices are up. They're soaring through the roof. Inventory's low. Yada yada yada." But it's a great time because you can afford more. Fast forward a year from now, and if interest rates go up to 3.5 to the 4% range, you're now knocking 150,000 of home value that you can go out and shop for down.
Invest in
getting into it, owning this home, starting to build some of your equity. And then you realize, oh my gosh, now I've got forced appreciation here. I can do a cash out refinance. I can take about 30,000 of this appreciation that I've netted. None of the cash that you've put into the home, just the appreciation you're pulling out, and you go and put it on another property.
Exactly.
And then you do the same thing. It's like using your mortgage, and this is probably the best way to look at it. We said a savings account and a mortgage, people can look at them the same thing. It's just a large savings account. You're just building up equity, which technically is cash on hand. It takes a little bit longer to get that cash on hand, but in theory, it's cash on hand. Either way, when you have that and it's just sitting there and doing absolutely nothing for you, why not pull from it and go and put it on another home and build a stream of income? And this episode can kind of tie into our reverse mortgage episode, because if you think about it, let's take the cycle of a mortgage. When you get a mortgage, and if you pay it off in 30 years, you get a mortgage when you're 30, you pay it off in 30 years, you're now 60 years old. Now you've got this home that you 100% own, and it's worth $600,000. So you've got $600,000 that's just sitting there doing absolutely jack shit for you. Mm-hmm. And you're just, now that you've paid it off, I don't have a payment anymore, but I'm comfortable because I don't have a payment anymore. Why not utilize that mortgage that you got 30 years prior, refinance 4 or 5 times, pull cash out, and go and get 4 or 5 more properties? So when then, now you get to the point where it's 30 years down the line and you still have 25 years left on your loan because you just refinanced, and you do a reverse mortgage. Mm-hmm. And now you've got your investment properties that are making you money, and then now you have a mortgage, a reverse mortgage on a house where you're not making a payment anymore. So it's just, if you know what's out there, and you can use these products as stepping stones, 3% to get into a home. Get to that 20% point. Now you start building your equity. Now you can pull back to 20%. Pull back to 20%. When you're young, why not pull back to 20% and use that cash on hand to go and get more homes? It goes into the Burr principle. That's literally like the Burr principle, is just using your mortgage and leveraging it. Just continuously using that money to go out and do more things. Add more here. Put this under my wing. You don't have to take your equity that you're pulling out and put it on another home. Maybe you're pulling out equity and you're updating your home. Now you're making your home more attractive to a renter, and now you can go from $1,500 to $2,200.
It's more valuable.
More valuable.
Yeah.
And on top of it, you just pulled your equity, but you updated the home, so now you increased your equity. You pulled $30,000 out, but you forced $70,000 into it, so now you're up $40,000. It's just, there's so many ways to use a mortgage to increase value in a home, to increase your income through more homes, and to not just let it sit there and be stagnant because you have a 2.5 interest rate. It's like sick. Sick.
One thing I do want to touch on real quick is going back to the whole idea of being fixated on an interest rate. When rates are where they're at right now, and Alex is talking about how if you wait a year and all of a sudden rates go up to 4 or 5, whatever it is, you're going to be able to afford $100,000 less in your home. Think about it this way. let's say you can afford a $500,000 house right now with where rates are at, regardless of, if it's 2.5 or 2.7, you're probably going to be right in the same range in terms of max budget. Let's say you can afford 500,000. You buy that $500,000 house. Yeah, it's going to be more competitive because inventory is low right now. Whatever. We'll get you a house. You get a $500,000 house now because that's what you can afford right now. And then a year from now, so you wait a year because you're so fixated on rates, all of a sudden they're higher. Now you can only afford a $400,000 house, and you waited a year. So in the first year of owning that $500,000 house, let's say it appreciates 3%.
4%. That's like the average appreciation that we can put into our calculators.
Okay.
It's 4%.
So 4%. That $500,000 house is now worth $520,000, right? Mm-hmm. Meanwhile, you waited a year and are buying a less valuable asset because that's what you can afford now. So, if you would have got in now your home is worth $520,000. Your wealth has increased, equity's built, cool. $520,000. But now you delayed a year and you're now buying a $400,000 house. Let's say it appreciates 4%. So now it's worth $416,000 in year 3. Mm-hmm. Or year 2.
Year 2.
Meanwhile, in year three of the $520,000 house, let's say it goes up 4% again, that's $28,000. Now you're at $548,000, and on the other house, you bought less, and you're at $416,000. Don't get fixated on rates.
Yeah, a rate truly doesn't matter.
Just get in it.
Yeah, don't even that's the number one question as a loan officer you get is, what are rates? Where are rates at today? And that's the thing is sick. If I'm on the phone with you right now, Joe, rates are at 3.5, but that changes tomorrow. That changes the next day. It changes the next day. Every single day, every hour, it's changing. Mortgage-backed securities it's a stock market. It fluctuates. It goes up and down. It's the same thing. When I'm looking at mortgage rates, I'm looking at the same thing. 100-day moving average, 50-day moving average. It's the same thing when you're talking stocks. Mortgage-backed securities are essentially the same thing as stocks. They go up and down. So with rates, why not just play the game? Get in, utilize all your equity that you now have, refinance it. Yeah, you're going to be at a higher interest rate. You now have a couple other homes that you're supplementing that higher interest rate and that higher payment for. Fast forward another year, rates go back down. Then you refinance this and you keep this one. Now you've got your property over here, your investment property, that you're doing the same thing with. You're leveraging your mortgage. If you really are afraid of leveraging your mortgage, use your first one to get into the second one. Leave the first one alone. Get it down to the lowest rate possible. Take your second one, get it to a third. Don't go back to your first home if you're that scared of your primary residence. But you could utilize your primary residence to pull from and go and put it on 3 different homes. You don't have to put it on one home. You could take $30,000 of equity and go and put 10, 10, 10 and now own 3 different homes.
Mm-hmm. One quick side note that I wanted to talk about real quick is the fact that I just did all of those interest and appreciation calculations off the top. So leave a like for that. You can fact check me too. I'm pretty sure that they're correct, but
it was right.
Yeah. Okay. Last question I have for you, or one of the last questions, is if you're talking to an investor, and as an investor, maybe we're going to say seasoned investor. As a seasoned investor, they're talking P&L out your ear. I need my P&L to look good, right? So they're going to get wrapped up in rate. You'll have that conversation with them. Is there any sort of programs for investors that maybe, I don't know if they're adjustable or I don't know if they're kind of a floating rate, but if you have an investor that's so obsessed with their P&L, you're going to have to get them a good deal so they can make money, right? So when you're talking to an investor, is there any sort of programs designed for investors or, that are more enticing to investors that are going to go flip a house?
I mean, yeah, there are, but there's no specific program out there that's going to be like, oh, hey, I want to go buy an investment property. I just get this killer rate because it's an investment product. When you're talking home financing, when you finance your primary residence, you're going to get the absolute best rate on that because you are most likely to pay back your primary residence. If you own a second home, investment properties, and shit hits the fan, for example, right now, the Big C, you're still paying on your primary because you live there. You're not paying on your other properties. So you're more likely to default on these loans than you are your primary. So therefore, no matter what, interest rates are going to be a little bit higher.
Mm-hmm.
It's more risky to lend to someone who has 10 homes financed. That's a risk. And an end investor who's giving you money to go and do that, that's a risk to them. So they need to get their risk back. So the rate is a little bit higher.
Yeah.
So for specific like investor programs, the best way if you want to talk like getting the best deal is when, let's see where you're qualifying at. You know, if you've got an 800 credit score and you've got a ton of assets and your assets look good, that's the big thing too, is if you've got if you got $2, $3, $4, $5 million in assets, that's going to help out your interest rate as well, because you've got a lot of collateral that they could go after in the event that you default on your loan, versus someone who has no assets and they're trying to do that. You know, there's just so many different things that go into it. But someone who has high assets, good credit, they're probably going to get a solid interest rate on an investment property. But if they want to get even better and they want to talk like buying that rate down, then we're going to talk about, okay, 3% qualifying rate. Does it make sense to buy it down to 2.5? It costs you this much. It saves you about this much on your payment. You can recoup that cost in 2 years. That payment reduction, you're now getting this much more in rent. So really you're recouping that cost in a year and a half. Oh shit, it makes sense to buy down your rate. Right now, investor speaking wise, buying down rate is super, super attractive. Same thing for investors who are refinancing their investment properties. Buying down your rate is big. Now, for certain areas, for example, like Nevada, you get more tax benefits for having debt on your investment properties than your primary. So take like my aunt, for example. It makes sense to refinance her investment properties and pay off her primary and leave the debt in the investment properties, because then tax-wise, she can write off more.
Okay.
So it's just like there's different way, like for investor-wise, there's different ways to look at it. State-specific, does it make sense? Like, oh, you're an investor, you own your primary residence here and you own a couple investment properties here. Maybe it makes sense to keep your primary paid off and keep your debt in your investments and be able to write off more for taxes. So there's just, I mean, investor-wise, there's a lot more that goes into it because they're seasoned. They know kind of the course versus a first-time home buyer who needs to be educated on it all. You know, the education piece is out the door. It's the strategy piece. Why are you trying to get into this property? What's this property going to be utilized for? How long do you want to hold this property? Is it going to be something that's a quick flip? Maybe it doesn't make sense to buy down the rate. There's just so many questions that go into an investor, but investor-specific products that on my end, I don't know of any right now that are like only investors can do this and it's a solid rate. Now, for investors speaking like jumbo, loans that are going to jumbo and stuff like that, those are super attractive right now because not a lot of people offer jumbo rates or jumbo at all. Mm-hmm. And on top of it, if you've got an investment property that is jumbo loan, you can refinance and pull equity out to 80%. So there's a lot of cash out refinances on jumbos right now that make sense to pull their equity and go and do it on another property. So it's just so many questions kind of go into figuring out if it makes sense for an investor who wants to get the best deal, because the best deal always doesn't come with the best rate. There's a lot more that goes into it, which stems back to the whole people who want the best rate. You know, it's not the best thing to go for. You should go for
the best loan program.
Best loan program with a payment you're comfortable with. If you can take a 4.5% interest rate and maybe get a ton of loan credits back and pay nothing for this loan, and that payment is comfortable for you and it's not a burden, you know, it's just like, it makes sense. There's just so many different ways to look at it. And each person, each scenario is different, and each one is going to make sense in a different way. You know, you're going to do a different program than I'm going to do. I have an idea of what I want to do with a property, and then I want to lease it back and do this. You know, it's just like, I'm going to do a different program because I know this is going to be beneficial for me in the long run. Same thing. Most people don't get those questions out of talking to someone, but that's like, if I'm talking to you, I'm asking you questions, figuring out why and like what and the motivation behind it, who your pressures are, because those are big. There's a lot of influence from like parents.
Oh, yeah.
Then it stems, okay, now do I need to start educating parents on different loan programs that go on? I mean, I've closed a loan through talking to a first-time home buyer and ended up getting their parents on a refinance. So it's just like, people don't know. There's a lot of education that can go into it. So yeah, maybe a seasoned investor needs the education behind it and can utilize if they're only shopping for the best rate.
How many loans should one get in their name?
I mean, just it
Say 10.
stems to a different. Each person is different.
10.
10 loans. I don't know.
That's the max someone can get in their own name.
You could start a business and get a lot of LLC stuff in it. I mean, I know a ton of people that have thousands of properties and LLCs because
you can only get 10 in their own name. That's just a fun fact. Is
the more properties that you do finance, the harder
your
interest rate is not going to become as attractive.
Yeah. But fun fact, any one individual can get up to 10 loans in their name. I want to get to 10. I want to have 1,000 properties though, so I'm going to have 1,000 properties.
If you're going to have 10 loans in your name, at that point, that's when I'm going to start to really question and be like, why have you not set up an LLC? Like, you're getting hammered right now on the interest rate because you have so many loans, and on top of it, your income has to be through the goddamn roof to have 10 loans.
I better do good deals then,
because when you're talking 10 mortgages. If we use an easy flat out number of 1,000 per mortgage, that means your income has to be over $20,000 a month, excluding your credit cards and car payments and anything else like that. That's just for mortgages because you can't be above 50% of your income.
It's not impossible, all right?
It's not impossible. I'm just saying at that point, when you get to that point where, holy crap, now I'm teetering my debt to income ratio, doesn't make sense to just start a business and wrap my homes in that business, because a lot of the times when you start to talk business financing and stuff like that, you can get a lot larger loans when you're talking business, and interest rates are a little bit better for business. And this isn't like residential I'm talking like business financing.
Yeah.
Like if you start a business and you have homes, like you can go out and get a credit card that's far more than your personal loan because you're a business and the interest rate's better than your personal card because you're a business. There's just advantages to having stuff in a business. So tax benefits, I mean, if you have homes and LLCs, there's probably tax benefits there. I don't know accounting to the point where I could tell you buy this home and do this because this is going to be the best way to write it off on taxes. That's not where I come from, but that's where I've got a guy. We're going to send you to our guy.
Always got to have a person.
We're going to get you, or a gal, she, him, they, them.
Yeah.
We're going to send you there because they deal with that on a daily. I don't need to wrap myself up in that and understand the whole write-off system and this and that. You guys go and handle that. But when it comes down to it, we need to be a team as a realtor, as a lender, as a financial planner, as a CPA. Because if that CPA is going to go and make it look like you made $0 this year, how are you going to go out and get more loans?
You're not.
You're not. So this needs to be a team effort where it's communicated and everyone's kind of on board. Like, hey, we need to make it look okay, this income so we can at least qualify for this loan this year. That's the conversation where if you're really getting into investing, you're going to have that person and everyone's going to be on your team. Those people are going to be on speed dial, and Trent and I are going to know your CPA. If we're working with you and you're that person, we're going to be in contact 24/7 with everyone involved, and then you're the end party that we're just really helping succeed.
Big facts. All right, I learned 2 things today. 2 big things. 1, take advantage of a home loan to build your financial future. 2,
even if it's a tough market.
2, have a great lender that you are comfortable talking with about building or following through with your plan that you've come up with. I think it's very important to have, like Alex and I were talking about, have a guy, gal, them that you're comfortable with and you can trust, because you can bounce those questions off them with no stress. I think
that falls back into having that guy doesn't mean you're going to go out and be shopping for the best rate every single time, because I have your best interest in mind. Exactly. What I'm doing in the background is your best interest because I've talked to you, I've figured out your plan, and I've understood what you want to do and where you want to go. Mm-hmm. I'm the person that helps piece together start to finish. You tell me where you want to be, and I'm going to put the pieces in line.
That's big, because a lot of times, especially the people that are fixated on rate, they're going to get into a situation where they're rate shopping, and maybe them on a better level than whoever they end up going with, but the person that they end up going with or working with because their rate was better has no idea what their plans are or their situation is right now.
Yeah. Has zero clue.
And that's huge.
Yeah.
That, I mean, that could cost you thousands of dollars if you do it wrong.
To the point, a prime example, someone who could easily qualify for a conventional loan, and we won't name names because I trashed on them in our last episode, but they went and got a competitive quote, and instead of conventional, this competitive quote was FHA, and they went with it, and they were totally fine with it. Mm-hmm. And it's like, hey, salute to you, high five, you got a home, congrats. But
they're paying $300.
6 months later, guess who came knocking?
Because they're
that same person, because they realized the upfront mortgage insurance and the mortgage insurance for life was stupid. All the while, I told them conventional is the best program and you can qualify for it. But what did they do? They put them in FHA. And it's like, why? They don't have your best interest. If you're shopping the best rate, you're going to get screwed in the long run. And that's just simple facts. If you have someone like myself and Trent who you can lean on and talk to, price, cost of the stuff, that's in the back of your mind. You're not even asking that. Someone who first asks, like, how much do you charge? How am I paying? It's just like, oh my God, do I need to go through this again? Like, no, you don't pay me directly. I get paid when this and this and this happen. It's just like, everyone thinks that what they are doing, like, you have to pay, and it's just like best rate, best deal, this, that. It's like, that's not the best for you.
My best clients have been the people that have trusted, you can tell they have 100% trust in you. And I had an example on a deal that I'm working on right now the other day. I said, hey, here are the couple options that we can take with the situation. What would you like to do? And they go,
you tell me.
Yeah, whatever you want to do it. That's cool. And in my mind, I'm like, wow, if all my clients were like this, I mean, I'm working for them. Like I get a ton of joy out of getting someone else a screaming deal or the best thing that they could possibly get.
Yeah.
And if someone believes in me and trusts me that much to say, hey, go do it,
makes the transaction that much better.
And they're not fighting with me because they think that they know someone from their outside influences, and I'm here doing it every single day, and I know what I'm talking about. And if they believe in me and they're not going to say, hey, well, my second cousin's husband said
does this and that
the commission should be 5.378 instead of 5.5. I think we're gonna he knows a guy that will do 5.378. I'm like, that dude's eating Cheetos, not marketing your property, and not answering the phone. But you got you saved $300. Like,
those are the type of people where it's like you have to show that value to kind of like earn that business, because they are so one-sided to being the rate shopper, being the best deal finder, this or that. But yeah, I mean, when you have a team, and this is something that I pretty sure I touched on in a Fast Paced Friday episode because of a transaction that I was working on where that we had an enemy on our side. When you have a team and everyone, you've got trust on both sides and everyone's there to see this get to the finish line, it's the best thing ever. Like, best thing since sliced bread. The feeling, everything about it is so money.
Oh, yeah.
And then when you have a transaction where it's just like, they don't trust you. Everything you're doing, they think you're screwing them, and you're pulling under their leg.
You're here for the money.
Yeah, and I'm just like, oh my gosh, it becomes painful on me to want to like work and work for you in that situation. It's just, I slowly start to lose interest in working on those files where people are pains. It's like, yo, we're trying to be a team in this effort. I'm trying to provide enough value to where you see the benefit in working with me. And If I haven't done that, then tell me, how can I provide more value? What are you lacking? Is my communication lacking? You just need to figure those things out, because most of the issues stem from communication in our industry.
Yeah.
Communicating is
absolutely
big. If you're a good communicator, then things are smooth sailing on all ends. So it's just figuring those things out.
Again, today, we learned that it's important to use a home loan to grow your financial future and your wealth. Do your research, talk to a lender. It is different than a car loan, and make sure you know the difference between leveraging an appreciating asset versus spending money on a depreciating asset. And the second one, always have a network of people that you can trust and talk to and ask questions that have your best interest in mind.
Yep.
I think this was a really good episode in explaining the benefits of creating debt for yourself.
Yeah.
And if as soon as
in
you
quotes.
Yeah, as soon as you view that debt,
It's so hard to say that word.
But once you view the debt as a positive thing and a vehicle to increase your financial future and grow with yourself or your family, it's going to change the world, and you're going to love the whole concept of real estate, I promise.
Yep. I agree. That's how you get super passionate about it. You're not going to find passion when you're that person that's going out and calling 50 different lenders, 50 different agents, trying to get the best commission deal here and the best rate here. It's like, that's not the fun in real estate. That sucks the fun out of real estate. Absolutely sucks it out of real estate. It makes every transaction no fun to work on when you're that type of person. Versus when you're the person that's like, I want to learn about this. I want to be fluid in this industry. I know that you've got my back. I know that this side's got my back. You learn 10 times more, and you are 10 times more happy with that transaction closing. Versus someone who got the best deal. It's just like, yippee, high five your partner, and now
go refi 3 months later.
Now you're off in La La Land for a little bit, but come back. I know you're going to come back. Yeah. No, what I was going to say is, if you follow our Instagrams, I absolutely flamed that company on my Instagram the other day because of a deal that I stole from them. So go follow my Instagram, alex.smagala Mortgages, and you'll see some solid content flaming companies that don't work hard.
I thought it was Dot Mortgages.
It's alex.smagala or alex.smagala. I don't even know. alex.smagala.
It's in the description. It's in the description.
Go follow my Instagram because literally, I get emails. I got an email. I should read it on camera, but it was comical.
Post on your story. Go follow him.
I don't need to post it again. I flamed him last week.
All right, that's all we got for today. Thank you so much for listening. I hope you guys learned something about leveraging your money to increase your financial future through real estate. Thank you, Alex, for answering my questions. Stay tuned for the next episode. We'll catch you guys later.
Peace.
Adios.
That's the end of today's episode. Thank you for tuning in. It truly means a lot to us. If you haven't already, please subscribe and share this with friends. This helps fuel the podcast and gets more and more guests on our show. Hey, go follow us on Instagram as well. Desk Talk Podcast. Go connect with Trent and I as well. We're on Instagram too, LinkedIn, you name it. Stay tuned for more episodes. Peace.